doing a lot of deep technical research into the stock market and into the money supply. And one of the things that I found out, looking at the Dow Jones going all the way back to the late 1800s, is that the markets have a very consistent sinusoidal nature. It goes into an oscillating series of cycles, and those oscillations are very consistent with one another in terms of long-term averages. And this is the part that I'm having a lot of trouble reconciling. The oscillations suggest that in the long term, over perhaps the next 10 or 20 years, that the stock market at that point will be much higher than what it is right now. And it basically contradicts a lot of the bearish fundamentals. So why is it that this oscillation, why does it point to a forecast that the markets will move higher when the fundamentals are so ugly and so bearish? Well, I think one of the ways that we can reconcile that forecast, assuming of course that that forecast is correct, that the oscillations will indeed continue to oscillate with frequency and consistency, one of the ways we can reconcile that is to look at the money supply, and specifically the devaluation of the dollar. When you compare 2016 dollars versus dollars back in 1913, $1 today is only the equivalent of 4 cents. 4 cents back in 1913. Now, when the dollar started to initially get devalued, when the Federal Reserve started to take control of the money supply, the impact wasn't as severe. But I theorize that as we continue to go along and along in the future, that the artificial imposition of monetary policy will have a very pronounced and an exponentially pronounced effect. Here's why. Let's think about this. $1 today is equivalent of 4 cents back in 1913. 4 cents. When you're dealing with numbers such as cents, you're dealing with the law of small numbers. Let's look at a penny stock market, for example. Let's suppose that you bought a stock literally for 1 penny, okay? And then the next day, for whatever reason, that stock is now worth 2 cents. Well, on a nominal scale, it's like just 1 penny. Your stock moved 1 penny, who cares? But on a percentage-wise scale, that is a 100% move. But that's the craziness of the law of small numbers. Small numbers make a big impact on something like a penny stock. And what makes the law of small numbers have an exponential effect on the monetary system is that we don't have a denomination smaller than a penny, okay? We don't deal with fractions of a penny. I mean, in a very technical sense, in terms of foreign currency exchange, yes, we do. You're talking about pips and stuff. However, in terms of just currency denominations, we don't have a denomination less than a penny. So if a penny stock moves, it basically, in order for a penny stock to have a legitimate, recognizable move, it has to move. The next biggest move has to be another penny. It has to move by 100%. Okay, that's the craziness of the law of small numbers, especially when you impose that law on this narrow framework of currency denominations. And I think that will have a severe impact on dollar devaluation. It didn't really matter when you're comparing 2013 dollars to, let's say, 1998 dollars. I believe $1 in today is the equivalent of something like 67 cents or whatever back in 1998. Okay, I mean, you can make some modulations there. I mean, we're talking about a reasonable differential. But when you're talking about comparing $1 to 4 cents. I mean, that's a huge differential. And the only lower denomination, the next lower denomination of 4 cents is, of course, 3 cents. But what does that mean on a percentage scale? That means that you're losing 25% of valuation compared to the value of $1913, okay? Because you're going from 4 cents to 3 cents. There's no such thing as a denomination of 3.5 cents. You hear what I'm saying? It has to go from 4 cents to 3 cents if it's going to get devalued to the next scale. And if it gets devalued again from 3 cents to 2 cents, again, that's a massive percentage scale. And from 2 cents to 1 cent, again, a massive devaluation of 50%. That's crazy. But as we get into these lower denominations, we are subjected to the law of small numbers, especially in the framework of currency denominations. And I think this is where Bitcoin comes in, or digital currencies such as Bitcoin comes in, because you may know that Bitcoin as a digital currency, it is not subjected to denominations in the way that we have been accustomed to. With Bitcoin, you can have percentages, and that is perhaps where we're going, because as the years go by, our dollar is going to be so devalued that it's not going to make any sense to compare it to a penny anymore, because it's going to be into fractions of a penny. But it may make sense to compare it in percentage-wise on digital currencies like Bitcoin, which are mathematical currencies. They allow an infinite number of possibilities in terms of a mathematical framework. So that's the danger. I think that when we look at the oscillations are suggesting, yes, the stock market, the Dow Jones, will be significantly higher over the next 10 or 20 years. However, it may get higher simply because of massive inflation. And inflation so massive that we no longer make sense of comparing dollars and cents, but we must compare now into minute denominations that are only practically possible through digital currencies like Bitcoin.